What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. We got some critical charts to go over. We got bonds and yields. They're making the headlines. We see financials doing very good, the banking index. We're going to be going over a lot in today's video. We're going to be going over indices, indicators, commodities, the dollar, bonds, and yields. And then I'm going to wrap it up with the conclusion with that big picture chart that you saw on the thumbnail. And it's all going to tie in. There's a reason why I'm keeping it there at the end, because it helps tie in the bigger picture here. Very interesting stuff going on. It does seem like it's at a very critical point to probably see the market move in a very aggressive way, whether that be to the upside or the downside here in the very near future. So yeah, let's just go ahead and get into today's show. All right, welcome back. We're going to go over the indices first, okay, starting with the Wilshire. Okay, I don't usually bring this one up. This is a broad-based index, right? Wilshire 5000 composite index. So a lot of things. It's important to watch this just to kind of get a good idea what the broader market is doing. And I marked out a couple lines here, okay? So the one that's horizontal, that's where the year started. You're going to see where the year started on multiple charts as we're going through this, but that's a very important line to keep an eye on, because if we're above the year, and we're positive for the year, the year is bullish so far, right? So you can see here, this is where, we opened up right over here in 2021. We came up, we back tested already once. So the year open did hold this support on the broader market, and then we bounced and recovered from that area. The next thing I want to show you is these two vertical lines, and you can see that is actually where we had bearish crossovers here on the MACD. All right, so we had the bearish crossover here. We saw pullback into the year beginning, and then we recovered. All right, now what we're starting to see right here on the Wilshire 5000 is the same thing. We have a bearish crossover. We're struggling to kind of get above for the last 1, 2, 3, 4, 5, 6, 7, 8 trading days. We've really been 9 trading days. We've really just been kind of moving sideways. And you can see here I have a couple EMAs. We have the 5, the 10, the 20, still in bullish context, but you can see now we are closed below the 5 EMA as of right now. Still, like I said, it is in bullish context, but I want you to notice the last time we had that bearish crossover was right here in January 26th, I believe it is. And then we saw some action to the downside. So let's be prepared and be aware of what the broader market is telling us right now. Let's look at the S&P 500 weekly time frame. Look at these blue squares if you're new here. These are piercing patterns that I labeled out on a previous market brief. And we said that, when we see these piercing patterns, a big red week and then followed through by a big green week, we've saw some momentum to the upside. And, we saw that here. We marked it out. We saw the follow through. And now we're starting to see, more of a bearish type pattern right here. So you can see we saw some strength moving up. And then we had an outside trading week. Dark cloud coverage is what this is considered, and this is just to understand the psychology of it. You can see a big, strong green week, relatively smaller range than the previous week, but then it was followed through by a gap up, went a little bit higher, and then closed through half of the green body over here, which just kind of really represents, the bears are kind of stepping up at this particular point in time. And you're going to see two vertical lines here, two horizontal lines here. So 3,900, you can see that's where this week stopped at. That's where the low and open up was of this week, and then we bounced from it from the previous week. So 3,900 is relatively a level that we're going to have to keep an eye on, because if we close below that successfully, there's no reason why we couldn't come test this 13-week moving average right around that 3,700 to 3,800 range quite quickly too. So we'll keep an eye on that moving into next week. On the daily time frame, you can see that we've been ping-ponging around in this channel. We got to the upper range of the channel. This looks very similar like it did in 2020. I'm not going to keep reiterating that, but it does. It's just insane. I post a lot about that on Twitter. We had the gap up, and then we just flopped through this small little tiny trading range candle right here. This little tiny guy had a lot of action within that day and a lot of emotions. There was a lot of things going on in the FinTwit community. A lot of different charts were getting posted. I posted a lot of different charts. There was a lot of noise. So a lot of noise can happen within these little tiny candles. The price percent oscillator does look like it wants to do a bearish crossover. We are still in bullish context overall. Bull channel. We're above the 20. We're above the 50. We're above the 200. Very similar like what happened in 2020. We woke up the next week and we gapped below the 50 period moving average. I don't necessarily think that's going to happen, but as we go through the remainder of these charts, I want you to understand that there are possibilities here that we do get a very sharp, aggressive correction in the very near future. And we need to be prepared for that, because if we aren't prepared, then we don't have a good entry point into where we'd want to get into next. Let's look at the Dow Jones. The Dow Jones has been doing nothing at all, right? So we've been struggling, kind of just bouncing around here for 1, 2, 3, 4, 5, 6, 7, 8, 9 trading days above this 31,250. So we finally, there's so much resistance, then we got above it, and then we really didn't have a solid breakout yet. I mean, it's been holding, as you can see, the wicks, but you got to understand from a bull's perspective here, you'd probably get a little wary. And the reason why is simply because maybe you get in here and you start moving up, right? And everything looks fine, but then you got to understand, like, every single day had bearish action. And the bulls stepped back up at 31,250, but you got to notice that, like, imagine buying in right here and then holding it through this and just seeing the big red day down, red day down, red day down, but then they bounce back. And then you see a little bit move, but then another one down. It's just, it takes a toll on the bulls. And you can see that the bears are holding up quite nicely so far around this 31,500 level. So if we do start seeing a move to the downside or a break below 31,250, my guess is that if you were the bulls within this range right here, you're going to be like, all right, I'm taking profits. I'm done with this, because you get exhausted by holding on to something that hasn't moved for quite some time. From a bullish perspective, though, from another perspective, I should say, so that's more of a bearish view, what a bear might be thinking about the bulls. But from a bullish perspective, you can also look at this chart and say, okay, it's actually just consolidating. We're still holding support. It's in bullish context. It looks like it's flagging right here. So yeah, if we start cracking above the high, which was 31,647, yeah, we can shoot up a lot higher. All right. The last thing that I want to just call out here is the price percent oscillator does look like it's kind of crossing down. We see the momentum of the histogram moving lower as well. And you can clearly see the negative divergence that I did not mark out, but you can see a high here to a lower high here, where you had a high here to a higher high here. So that is a bearish divergence, a negative divergence. On the transports, I'm bringing in the transports because the transports makes up a big portion of the Dow composite, right? And it's considered Dow theory. I'm not going to explain what Dow theory is, but if you want to Google Dow theory, it's looking at transports and then the industrials. So, you know, you build, you make, create products, and then you transport them around the world. That's the most simplest terms ever. Hanging man candle, that's really all I wanted to point out right here. You saw a big green candle, then you get a hanging man candle. If we get a gap down next week and then a big red candle, that is a reversal type candlestick pattern. I will say the price percent oscillator doesn't look too bad right here. It is a negative divergence, but it does look like it wants to do a bullish crossover. You see the histogram moving up on this chart. Really not too much action has been going on. You can see this piercing pattern right here on the weekly time frame. You saw it right here, and then you saw it down here. And we had follow through every single time. Boom, boom, and then boom to the upside. So this could continue to move up higher and higher. We also have a negative divergence on the RSI. Yeah, so it's something just we need to keep a close eye on. And then I want to show the DJW, the Dow Jones Global Index. All right, this is big. I mean, just look at this move from this. So this blue channel, we overshot it right here during the pandemic, and then just poof, skyrocketed straight up into the air. We're trading clearly above the upper Bollinger Band. This is the monthly time frame. The month is not over yet. We still have one more week of trading. The previous month, it was a nasty hanging man candle that got no follow through. So yeah, we are up trading clearly above the 5 EMA, above the upper Bollinger Bands, negative divergence. You can see the price percent oscillator super overextended. And if you just go back in history and see these previous overextensions, it followed through with a 10% correction, a 51% correction, and a 10% correction at these overextended levels. So yeah, if we can overextend to the downside in these channels, yeah, why couldn't we overextend to the upside? And that's exactly what we're doing right now. So be mindful of this, okay? This is a very strong move. You can't, I mean, if you really think that you can just enter in and the market's just going to continue this path straight up into the air, I mean, let's be real. That's never been the case at all anywhere. I mean, you can just look, I'm going back to 1996, right? So yeah, it goes up, and then you get a big move down. You go up, big move down. And these might not look like big moves, but that's a 10% move right there. This one was even a bigger move right there, and then followed through stronger, huge correction, right? Big move to the upside, big move to the downside. and you can see it. I'm not going to keep going over, but you can see big move down, up. So what I'm trying to tell you is you got to be careful and mindful that, yeah, this, like, it's a vertical line straight up in the air. Okay, so if you're buying stocks, like a lot of people ask me about certain stocks to buy, and I pull up the chart, it's like, dude, this has gone up 130% in 1 week. What do you mean buy right now? Like, yeah, you can get really lucky, but just look for something that hasn't moved like that. I don't know. Russell 2000, weekly time frame, hanging man candle. Pretty nasty hanging man candle at that. Negative divergence and structurally just insane right now. You can see it's just a rising wedge or bull channel, whatever you want to call it, but it looks more like a rising wedge to me. I would just love for this thing to just roll down to 170, just a quick hit. I would be buying so heavily right up in this range. That would be awesome. I don't think it's going to happen. Maybe it might. I'm not going to bet on it. But this aggressive move to the upside, also, it's going to have to take a breath here eventually, and it's going to result. The higher it goes and the straighter it goes, it's going to result in a stronger move to the downside. That is just how it works. And keep in mind, it can be very quick and very fast. All right, so you got to be prepared for that. And it might not be straight down, obviously. It might come down to the blue channel and then make another high, right? And then maybe potentially have a stronger hit to the downside. So you got to also just be prepared and know levels that you'd want to be buying into. Because if you're not prepared, let me tell you what you're going to do. I'll tell you exactly what you're going to do. If it starts rolling over, and say we break down through this channel, and you do not have an area where you want to buy, or maybe if it comes down, let's say to 205. All right, 205, that's kind of where this weekly 13 EMA is right there. If you don't have a plan to buy in that range, which could offer up a great support to make a short-term long position or a long hedge if you are short, if you're not prepared for that, your thoughts in your head would be like, no, I think it can go lower. I think this is where the market's crashing. Nope, yep, this is going down. It's going straight down. And then you might miss out on a large move to the upside or follow through to the upside. Just like if it came down all the way to 170, and you're not watching this or prepared to see like that was resistance, this would offer up a lot of support. If you weren't prepared for that and it was coming down here, you'd be like, no, I'm not touching this with a 10-foot pull. It's down, tremendously from 230 to 170 in a very short period of time. You'd be like, yeah, no, it's going to continue to crash. Meanwhile, if you were prepared and you started buying into these levels, you would see some sort of strong bounce. Not guaranteed, but you're putting the odds in your favor by mapping out these key levels. And clearly, resistance, and then it couldn't even test it again. It had to gap over it. Okay, so that just goes to show you how strong and how key this level is right here around 170. I'm going on a tangent. On the daily time frame for the IWM, the last market proof we said, despite popular belief, this actually looks like a good buying opportunity, even though it's coming to the bottom portion of the channel. So it looked like it was falling from 230 down to 220. So people were probably a little hesitant. But if you were watching this, you'd been like, I told you, like, yeah, I'm a little hesitant because this is crossing over. But, technical analysis says, bullish context, the 20 above the 50 above the 200 moving average in a bull channel. Yeah, it makes sense. You can probably see a move higher. But the only thing was we looked at the weekly and we're like, yeah, but the week doesn't look all too good. So it's a very hard decision. You might be able to make a short-term gain here, but you need to be aggressive with profit taking. All right, let's look at the NASDAQ. And I tell you, once we get into the commodities and all this stuff too, the indicators, I'll wrap it all together in the conclusion section. If you haven't done so already, really appreciate if you hit that like button too. The NASDAQ, we're going to look at the Qs. Bullish context, right? Not the greatest looking day for trading. You can see that we had a gap up and then we closed more than halfway through the green body here too. That happened right over here. You can see we had the gap up and then close, and then we had just weird price action, right? Gap down, move up higher, gap down, moved up higher, but you can see it's trending a little bit lower here. So still above the 20, still above the 50, still above the 200 in a bull channel. I'd say let's be a little bit more careful if we start breaking down through this channel and even below the 50 period. We can, it might suggest that there's more downside. The price percent oscillator has been going kind of sideways for quite some time now, but now you're seeing a decisive bearish crossover, still above zero though at this particular point in time. Qs on the weekly time frame, also, we marked out these piercing patterns where it had follow through to the upside. We had that follow through to the upside. This week, we had the gap up and we closed below. Just an outside trading week. This is a bearish type candlestick pattern. It's not it hasn't been confirmed to the downside yet, but if we do get a confirmed close below the low of this week, which was 328.36, that could suggest more momentum to the downside. But you also got to take into consideration the bullish context that it's in. All right, so if we go down lower, you got to, where can we potentially look to buy? Well, we have the 13-week moving average. We've crossed below it a few times, but we instantly got bought back up. This right here, just about 305, looks like it could be a good area of support. We had resistance, boom, rejected, and then finally broke above, back tested. Maybe we get a back test and go if the bullish momentum continues moving forward. On the SOXX, this is the semiconductors. Now, semiconductors is very important to look at while we're looking at the NASDAQ because the semiconductors make up a big portion of the NASDAQ composite. Really what I want to call out here was just it's clearly a rising wedge. It's been going straight up in the air, has a negative divergence, and then this hanging man candle we have needs to be confirmed to the downside if anything, but I got to call it as I see it. That is a hanging man candle after a big solid green week 2. So, that if we get a gap down or a big red bar candle next week, that would suggest a bearish candlestick pattern, which is also a topping type candlestick pattern too as well. Let's look at the NYSE. We're only going to look at the weekly time frame for the NYSE, the broad market index as well. Rising wedge pattern. You can see the doji type candle right here after a big solid, once again, piercing patterns. You notice these piercing patterns kind of showing up everywhere, but we had the follow through. Notice the range of this candle. Okay, so what I mean by range is the low to the high. All right, so it's just a big solid green week, and then you see a big solid green week. However, you can see the range of the candle is a little bit smaller. All right, and then you get a little bit smaller with this candle too as well. Yes, this is a log chart, so it could be skewed just slightly, but they're within 3 weeks right here, so it's nothing too crazy. But what you want to pay attention to is when the range shrinks after a strong move, it means that the momentum could be slowing down just a little bit before either a period of consolidation, a move higher, or a pullback into support. So something to keep my eye on. Now it's time to go over some indicators. We have quite a bit to go over, and then we're going to get into commodities, then we're going to get into the dollar, then we're going to get bonds and yields, and then we're going to show you that conclusion chart. The 13-week rate of change, this middle chart right here, is the lumber to gold ratio. It has been heading down pretty fast in the month of February. All right, so something to pay attention to. We're still above 0. When we get below 0, that's considered a risk-off move. This is part of Michael Gaiad's research. He was in one of the interviews that I did. You can read his white paper, the lumber to gold white paper. Or you can just watch the interview that we did with Michael Gaiad. Very good interview. He also stated, because I asked, one of the questions I asked was about a 3-week rate of change. Or I said, well, why use a 13-week? Is there any other one that you can use? And he said, well, the 3-week works well too, but you could be wrong more often, or you can be right sometime sooner. And I wanted to call that out, like the 3-week rate of change. It's still positive. It's not risk off yet. It sure looks like it will be next week, but we don't know yet. But yeah, just notice just right here in February, a solid shot to the downside, not quite below 0. When it gets below 0, it means the following week is a risk-off type environment. So we got to see and just track this and see how this goes. It doesn't mean that the market's going to crash by any means. Although I will say that it has predicted some pretty nasty movements. You can see right here in February, it crossed down below that, and that was a risk-off move. You would have missed the entire crash right here, and then you would have got back in risk-on more right around here. Now, if you know how to read charts, you would have been able to spot some sort of things that this was more of a bottoming type pattern, which we'll get into if that kind of stuff happens again, and you'll be able to watch that play out live or day by day when we do the charts. But yeah, it's predicted some pretty gnarly movement. So it's not saying that, that's for sure going to happen, but what it is saying is that the conditions for an environment of increased volatility or vol spikes are very real. Here's the Pring bottom fisher. I'm only bringing this on because this is really good at finding market bottom. So for example, when we talked about the lumber to gold ratio coming down and crossing here, and then, we saw the huge vol spike, right? So the market went way down. Well, just note that when it came back up here, you would have missed a pretty significant move to the upside. However, when we watch things like the Pring bottom fisher in March, or just before the end of March, it actually told us right here, right at around the bottom when we could have got right back in. So Pring Bottom Fisher is very good at finding market bottoms. Sometimes it's really good at finding market tops. As you can see right here, it found, you know, a little bit delayed, but it was this bottom right into here. This and when it gets below the green, that's a little bit better for in my opinion. But when it gets below the black line, that also helps find some market bottoms too. So right here it crossed over, it captured this market bottom. Right here across, it captured this market bottom. But clearly you can see that it was a delayed response, which is fine. You know, this was November. November we talked about the seasonality charts. So we actually, you know, said, yeah, in the beginning of November, you start to see the market move up. This was just an insane move on the markets, but that was right around the presidential election when we looked at the seasonality charts. And then right here, this crossover could have been marking this this bottom right over here. Just slightly delayed response as well. So yeah, it's just, you know, it's really good at helping us find that, but it's even better when both the signal lines cross below the green line here. Here's the sell signal. Sell signal is not telling us much right now, but you can see the purple line shaded in the back, and then we have this symmetrical triangle, so it's kind of consolidating sideways. You can see that in the 10-period moving average. When the 10-period moving average, the black line, crosses above the red line, that's the 0.8 marker for the CPC. This is a put to call ratio. We consider this a sell signal. And that doesn't mean like, you know, you got to start buying puts. It means to one, just be very cautious in the environment and make sure you have profits locked. You know, if you want to take profits off the table. It has predicted some pretty gnarly moves in the market as well. You can see right here when it crossed above it, the market moved down to the downside. When it crossed here above it, the market moved more to the downside. It also picked up that March crash there as well, or February crash as well. Let's look at the three BP charts. We're going to look at the NDX, the BP NDX, BP SPX, and the BP INDU. Negative divergence, as you can see, the market's moving higher. It's not the greatest sign, okay? So it's not being supported by these charts as the market moves higher. So that's, you know, not the greatest sign in my opinion, but from a bullish perspective, it has room to run up higher, you know? So you can think of it that way. Same thing here with the BP SPX, negative divergence as the market continues to move higher. We do call out, I really like these charts for finding overextended areas on the RSI. So oversold, overbought when it's above 70. So it still has room to go higher, right? We'll see if it does, but we really like to get into this when it gets into oversold. So when it got oversold here, we called that out the day that it was oversold. And look, if you just look up, that was on that pullback into the 50-period moving average, and then we started posting a lot more charts and a lot more setups. And everyone's like, oh my God, you know, all of these ones are really doing well. Well, I mean, there's a reason for that. We use intermarket analysis. We're looking at other various aspects to give us that edge. And that little tiny signal gave us a huge edge on multiple different charts that we posted. And then all the charts that we've been posting as of recent, we had to give the warning sign because we're coming into the upper channel on the S&P 500, and we're like, yeah, I mean, we'll post these. You know, they look like good setups, but you got to be a little careful because of where we are in the markets. Here's the BPI NDU. This is a negative divergence. Boom to the downside, and then you have the flat little top right here, and then clearly the market was moving higher too as well. Let's look at breadth of the market. Look at how 2020 looks so similar to 2021. Negative divergence. We're still negative breadth. That makes sense because the market moved down slightly there. So we'll just keep an eye and see if this continues to either one, play out, or you know, yeah, we'll just see. I like to use this for overextended moves too. So when we did get down to this range, we called that out. And why did we call it out? Well, because, well, first off, okay, so yeah, let me reiterate this. Remember we just talked about the BP charts, and we said right here on the BP SPX in February, it was getting oversold, which means it has an opportunity to bounce. And then the S&P 500 was coming into the 50-period moving average. Well, right here, it was getting to minus 60, which is an overextended move on the NYMO. Okay, and then look at the market right here, pulled to the 50. And then that's one of the other reasons, one of the more ideals that we put in our favor to feel more confident going long in some stock positions. Here is the percent of stocks above the 200-day moving average. Okay, we have a negative divergence right here. I'm just calling that out, but we're still really high. So it's basically saying 87.98% of the stocks in the S&P 500 are above the 200 period moving average. So a lot of breadth in that market right now, according to this specific chart. You can also read this chart from a contrarian point and say that, okay, these are just been jammed up levels. We're due for a correction, because sometimes when they get up to these levels, they don't last at these levels for that long. So we get some pretty sharp corrections. Here is the same chart, a little bit differently. This is for the NASDAQ percent of stocks above the 200-day moving average. And, you know, I'm just marking out how 2021 looks pretty similar to 2020. You can see it was jammed up in an overextended territory for quite some time, and then boom to the downside. You know, it hit here really quickly. You can see it came up and then boom to the downside. You can see the market fluctuating right here. And then we've been jammed up here for quite some time and very high level readings. So hasn't taken, you know, a moment to fall below that for, you know, since November of last year. So basically after the presidential election came into place, they've been just jammed up at these high level readings. Last but not least on the indicators is the VIX. Important one. You can see this blue trend line clearly is some important level. Right here, it got rejected. When it broke through, it was a very decisive vol spike, boom to the upside. When it got to this level, what did we say? We said, this is the area where you want to start buying stocks despite what you might think, right? Because when it shoots up to the upside, you get a very big scare and this was a very decisive, aggressive move. So we got a big scare in the markets. The markets pulled back and we said, okay, we're coming into areas of resistance. Let's go ahead and find certain stocks. Boom to the downside. Those stocks played out well. And now it's been kind of just in this consolidation, sideways movement, still below this trend line and below this one here. Overall trading within this bigger channel and still relatively high. It still hasn't filled this gap right down here, or even hasn't really tried to fill that gap for the last week of trading. So there's very crazy stuff going on in the markets right now. It's very interesting to me that the market's trading at these all-time highs, but yet the VIX, the fear index is still trading at relatively high levels as well, which is different to say the least. Now let's look into commodities. This is going to be importante because it's going to mirror, you really want to pay attention here to the commodities because we're going to try to tie it in all together with the dollar, bonds, and yields and at the end. So commodities, first off, I'm going to start with black gold. This is crude oil, overbought. This is how the week started. So last week, I believe we showed this chart or, closing of the week or whatever. We marked out this area of resistance, all right? And we saw this big aggressive move to the upside. We're like, okay, pump the brakes here. Energy sector has been doing really well, probably because of this move. It helps out a lot, but now we're coming into resistance. Let's pump the brakes here. RSI oversold. This is a pretty nasty shooting star type candle right here. A reversal type candle. You can see it's done it here. It's done it right there. Those two. Doesn't mean that it's going to fall down or anything like that. It needs confirmation, but it could also mean that it's going to consolidate. I mean, the trend is still bullish. Okay, the candle doesn't look that great, so I wouldn't go long here. I'd want to wait to see if we can get above this red line because if, once, for example, watch, so I'll check this out. Support. You can see it going boing, boing, and then broke through. Once support is broken, it becomes resistance. Bounce, rejected, okay? Rejected. So if then once resistance is broken, it then becomes support. So if we break above this, that 62, to 65 range, if we can clear that, that could become now a new level of support, which could be mean that we can see more aggressive moves to the upside in the price of oil. All right, but you'd want to wait for confirmation. All right, so here's gold on the daily time frame. Has been getting just obliterated since August of last year. Last year. I'm getting all my years confused, very confused. We did break out of this 1760 level last year, and we saw just this monster rally, just boing, just straight up into the air. Got everyone super jacked up, right? Just straight up into the air. Well, guess what happens when things go straight up in the air? This is another reason why I'm pointing out all these other charts that go straight up into the air, all right? They go through times like this, okay? We get these markup phases, markup phases, and then we get these periods of just decline, all right, or distribution and decline phases. I'm not going to go over the 4 stages of the market, but this is typical behavior. And really what we're seeing also the correlation here is you're seeing a spike in yields. in the 10-year specifically, the spike in yields, this is literally just the perfect inverse correlation. You're seeing this go down, gold, and you're seeing the 10-year yield go just from this point up. And we'll show you that chart. It's pretty intense. So are we going to break down through this? It suggests that we will, but there's also a couple charts that I'm going to show you that even if we break below this, that could literally, it could just be a very big bear trap before we start heading north again. Now, the crossover here, that's called the death cross, right? The 50 period cross below the 200. But keep in mind, the 200 is a big moving average to turn. So it's still trending up. But it's not the greatest thing to have price action below it, because the more it stays below it, that means the more this is going to start turning over. Now you have the 50 period crossing below that, so this is not necessarily a place you'd want to go long at, because you would be betting against this short-term trend. However, we got to watch it daily, because if we start seeing some sort of signs of strength, or if this support starts to hold, then we can consider getting in. But as of right now, it doesn't look the greatest as of right now, but that doesn't mean that it can't change in a snap of the finger. Silver doesn't look nearly as bad as gold. You can see I just threw out resistance here, and you can see it was flagging down. We broke out of it, then it acted as support, and this trend line is now support. So I'm just thinking I'm going to watch this trend line here. If that breaks, then I could see silver heading a little bit lower, potentially into the 200-day moving average as the next area of support. It clearly bounced at this trend line, which is confluence with the 50-period moving average. So yeah, it could be this cupping type pattern, and then if we get above 30, like we had one solid move here, and we're hearing a lot of this old silver squeeze stuff, and we're hearing about the like the SLV and certain silver ETFs have to accumulate more silver within their funds. So to me, it's an industrial metal. Well, to many people, it's an industrial metal, and it's also precious metal. So it can win on multiple fronts. I think silver is a great buy. Buying the physical metal right now, though, the premiums are pretty darn expensive. So you can look into like PHYS or SLV, I guess. You just got to know the risks involved with owning the paper asset and kind of what that looks like, if it's backed by real silver, if it's not backed by real silver. You got to do your own research there. Sprott Money is a good resource. They have some good funds. I personally, I trust them. I'm not endorsed by them by any means, but yeah, I personally like Sprott Money. And then also APMEX. I like APMEX for physical. There's other good ones. There's JM Bullion. There's all kinds of other stuff out there. Let's look at the dollar. I'm going to be wrapping this all together here soon. Just bear with me. So the dollar is up here. The S&P 500's here. I've been talking about how much of a reflection and mirror they look like. That gray line, this is an important one. That's where the dollar opened on the year, right? So we're still above that. Okay, so we're positive on the year for the dollar so far. Right? We moved up, and now we're starting to move a little bit down. There's no decisive trade right here. All right, there's no decisive trade. It's been in this trading range. We need to see, I would suggest that we're going to start seeing moves to the downside if we crack below the year. We're around 90, even more so if we get below 89.50, the low of 2021, which was right. We opened here and then we headed down lower, then we recovered. So we are still in the short term putting in a higher high. So that is a good sign for the dollar so far. And if the dollar wants to continue to move up with some aggressive moves, the speed of the move up, that could put weakness on the S&P 500. You can see right here, it got rejected. This got rejected. This moved higher. This went lower. So that's just a simple way to look at it. It's been really just this perfect mirror, inverse correlation at almost darn near -1. So doing the exact opposite is what that means. Yields, bonds, yields. So first off, holy moly, this is an aggressive move. All right. So first off, this move right here in 2021, right? That spike sent the dollar a lot lower. So remember what we talked about with gold, right? So let's look at 2021 from here. Oh my gosh, from 0.9 to 1.34. So that is a fast move on the 10-year. But other people will say, yeah, well, it's still relatively low. And they would be right to say so. Let's look at gold from 2021, right? Basically up here, straight to the downside. All right, so there's an inverse correlation. So we're going to map out, I'm going to show you some charts of where we might run into resistance. And that might be good for gold. It might be if we can see it move down lower, or it might slow the bleed on gold. So we'll see how that plays out. But who else benefits from these higher yields? Well, the banks have been doing very well. Why? They borrow short term, they lend long term. It's a double-sided sword, unfortunately, right? So yeah, we're pricing in right here growth and inflation. I think that it's more inflation than anything, right? But then the market might be pricing in a recovery because of, the vaccine rollouts and, the new administration, or, you name it. There's a lot of narrative that we can create. As I see it right now, the curves are steepening significantly and fast. And then we have the 10-year and the 30-year also rising fast. Now, they're still relatively low, right? Now, who doesn't benefit from higher yields? Well, first off, consumers don't, right? So the higher that these go, and the pricing on housing, for example, let's look at the 30-year, 2.14, and the 10-year, right, 1.34. If these continue to rise and rise, and the market, the housing market, for instance, the home prices have just been insane, who really benefits? Well, first off, the banks will benefit, but at some point, the consumers are really going to feel the pinch there. And, my buddy works in the, even my brother, they work in the mortgage industry, real estate industry, and they've been on fire lately. They've been doing exceptionally well, but, even houses that get listed, they get 10 offers. So they just keep getting bid up and up and up and up. That is not a good sign for, that's a good sign for the seller, because they're, they get to sell their house, but now they got to go buy a house that costs significantly more, right? So it's just not healthy market behavior to see this taking place. Me personally, this is just a personal opinion, I would much rather have higher rates and a lower cost home, right? And then if rates go lower, I'd like to sell my home at that time, because chances are you get a lot more money selling them at a lower rate and then buying at a higher rate, because you can buy the house for a reduced cost. And that works out, if you save money, right? But unfortunately, with rates so low, you lose money by saving money. You can save 20% for a down payment on a home, and that takes you a year, 2 years, 3 years, whatever to do. And then in that time, that house is now worth $60,000 more. That median home is now up $60,000 more. So that 20% that you saved completely gets just obliterated. It's super unfair. And, this is just complete distortion. Now, I've been saying that the bank's been doing really well. Financial's been doing good. Well, just look at 2021, right? So right here, this line, they shot straight up in the air. So you tell me, there's no correlation, right? 2021, straight up, financials, 2021, straight up in the air. So yeah, BKX, the banking index, right? Made up of the 24 institutions, banks and other various things, 24 in the US, 24 largest, doing great. Right? We had a nasty month the previous month. This month so far, up 16% in a month. Holy moly macaroni. Now we're moving into this red zone. This is where I want you to pay attention. This is a big area of resistance right here, folks. Big area of resistance. So they're benefiting right now from yields going up, right? 10, 30, they're benefiting from these short-term crush down to zero. And the curve steepening right here. They're benefiting right now. But at what point do they not become beneficial? Well, first off, this red zone that we marked out here on the monthly time frame, we've noticed that, when it gets up in these levels, bad things have happened, right? But they've came up to these levels with rates trying to be moved up. All right, tightening taking place in the financial system. This is the Fed funds rate. And it gets up to this level, and then boom, crush it down to zero, right? As the market completely, just rolled itself over, then hold rates to zero, then the market recovers, and then we're like, okay, now it's time to lift rates again. So they start lifting rates again. When we get up into the red zone, nope, we can't do that. Let's move rates back down to zero. And then the pandemic hit on top of that, which we crushed them even further, and then plow right through to the upside. So maybe holding these rates down here, this is going to completely go north and continue to move higher. However, that would also kind of mean that yields would, right? They would have to continue to go higher, and that could very well be the case. So I'm telling you this because, first off, if yields continue to go higher, 10-year, for example, we'd still feel pressure on gold so far because that correlation has been accurate. This is the 10-year on the weekly time frame. Okay, since August, boom, straight up into the air. First off, now it's time to pay close attention to where we are on individual. So I've been showing this chart, the line chart. Now it's time to bring out the candlesticks on the 10 and 30-year because we're getting overbought and we're coming into an area of resistance. that 1.4 to 1.5. At what point will the Fed react? At what point will the Fed respond? Do you really think that they want to do yield curve control? I don't know. Can they be forced to? Potentially, right? Obviously. Now, at what point would they do that? Like, would the 10-year have to be way up here? Back to 2018, before everything started falling apart over here in October, and then yields started crumbling? Perhaps. But right now we're coming into an area of support. It bounced, then it broke down completely from that support. Now, once support is broken, it then becomes resistance. And we're coming into that 1.4, 1.5 range. So what if we get here, we're overextended on this side, and then we start seeing it either consolidate or draft lower, or even just get rejected at that specific point. It depends on what the market really wants to do with it. So we got to see that, but just call it out as it is. This could be a good signal that we might see strength in gold. We might see strength in miners, potentially. You never know, because if we see strength in gold, sometimes we see the strength in miners follow suit. 30-year, we broke through. This is something I want to call out here. So we pulled support, right? Well, if you just look over here, and when we broke through that level, it really crashed to the downside, but we actually already broke through that here. So yeah, we're getting to the overbought range. So I'm looking at this area as a level of resistance at 2.3 to 2.4 on the 30-year. You can clearly see it was rejected, rejected, rejected. Kind of a falling, rising wedge type pattern here, or bear flag, whatever. And then it really crushed to the downside. So it still has some room to go, which means it could put pressure on gold. And the banks still have the opportunity to move higher. But keep in mind, they're here. They're in the red zone. So, it's just, we're at a very critical point. We're at a very critical point. And then when I show you here, this is the TLH, the 10 to 20-year bond ETF. We had this channel down, we broke through that, and now this is running in to oversold territory. Price percent oscillator is super bearish, and we're coming into this previous resistance, broke out, then it becomes support. So we're coming into that area of support. So this could be setting the stage for a potential change in momentum, period of consolidation. It's very hard to say, but we're hitting critical levels on these various different charts. So I want to wrap this up here with the conclusion and the final chart. I've been talking a lot. I hope you take notes, because this is actually very important levels. These are very, very important levels in the market right now. So what I want to kind of wrap everything around is, one, this is what makes it so difficult, is we are in very bullish context overall. Okay, so being in that we're in bullish context, and by the way, it's been an aggressive move. So there's all these different things lining up, right? So we have a very aggressive moves to the upside. We're in bullish context, but by having very aggressive moves to the upside, we can have even more aggressive moves to the downside. So take this into consideration. We need to look for areas of support to buy into, okay? And you need to set up trades around those levels, and we'll continue to walk through those levels as the days progress, all right? So that's part one. So bullish context, look for those buys. On the flip side to all of it, I'm bringing back the big picture chart. Why am I showing this big picture chart? Well, because now other people are taking notice of this same exact chart. They probably are just now, maybe they probably already knew about it, because I'm talking about some people that actually are very, very intelligent, much more intelligent than I am. But they're starting to actually show the chart after the fact that we've been talking about it for quite some time. You can even watch my big picture video. A lot of people they follow through. This didn't age well. It's like, well, you got to give it time. This is a big picture chart. So, if you let it go for, 6 months, that's not that long of a time frame. But this is what this is. You have the yield curve inversion right here. Now, what am I trying to show here? Well, simply put, when it goes to red, that's an inversion, all right? So we have an inversion here. This is what I mean by big picture, right? The early 90s, 1990 to even the late 80s, right? This is as far back as I can get right here on this spread. Okay, inverted, right? And then we moved up right here. You can see, well, yeah, the market kind of pulled back here, but then went up a little bit and kind of consolidated sideways. Here, the inversion that took place, and trust me, this is important. You can see that once the curve started to steepen, right? This is the 10 minus 2. The 10 divided by 2, or 2 minus 10, whatever you want to call it, steepened the curve, the market rolled over, and then we had the 2008 financial crisis after the inversion. We have the inversion here, that we had the pandemic. Now, I don't believe that was because of this yield curve inversion. If it was, man, talk about that would be insanely manipulated. Imagine if this was all created because of what was taking place in the market. So it gave them, and what's actually crazy, and this is just completely conspiracy theory, but how the heck did they respond with all those programs within the matter of 4 weeks? right? Like they had this in their back pocket. You can't just create these new, what did they have? 4 or 5 different acronyms of these different programs lined up in that short of a period of time. No way. So it was, I mean, maybe there's a way. I don't know. I can't say that with absolute certainty, but I just don't personally think that you can create those type of programs at this amount of scale with that much market distortion, you know, in a very short period of time. Like that's something you had to have been prepared for. Well, the market came, they immediately responded with all these programs, and then the market went through the roof. Boing, sky high, right? Now, what's important about what I'm calling out about this chart is you'll see this red vertical line right here. All right, the red vertical line, that's the 100 bips or basis point move from a yield curve inversion. All right, we just now crossed over it. All right, the same thing took place here. Right, the market literally from 1991 to 1992, or even mid 1992, once it went from an inversion, the market pulled down. Yeah, it recovered a little bit, but then it went sideways for a year and a half. Here, when we got above. Now, when it got inverted and started going to, back above zero, the yield curve, it went down. But you can see we saw some mass selling take place, some very aggressive selling once it reached 1.0. All right, on that. Same thing here, financial crisis, inversion, curve starting to steepen back up. Now, we've already talked about this in other videos plenty of times. The steepening curve has led to recessions and very, very poor market performance. All right. Bam, to the downside. As soon as it hit that 1.0 marker, you can see here very clearly, that was almost the dang near top, and then plow to the downside. Now you can see this, support, we broke down, then it's been acting as resistance, and now we're trading above it. Could this be that overshoot? You got to see the negative divergences on the chart too. Bam, eventually that kind of stuff can play out. But now, you take the negative divergence, the overthrow, overshoot, the inversion, back above the 1.0 right here on the curve. You can't call this with absolute certainty, but rates are flush to zero. The yields are rising. That means the spreads can continue to rise. And every single time it's went above 1, it's went even significantly higher. So right above 1, significantly higher, above 1, significantly higher, above 1, significantly higher. So the spread, to me, history suggests that the curve is going to continue to steepen at these points, at these levels. All right? So, you got to be very careful here because all the signs and all the signals, suggest, you're hearing one thing that, the economy's getting back on its feet, everything's good, although we've been blanketed by, blindfolded by stimulus and government programs and support, but then we're seeing like this kind of stuff take place. So yeah, if I've been beating the horse about you need to be careful when you trade and when you invest, well gosh, just look at the charts, look at the intermarket analysis, look at what's going on. Where can you save yourself? Where can you protect yourself? Everyone now is trading stocks these days, right? It's like the whole gamification. We saw that on that whole little conversation with Congress or whatever that was, whatever you want to call that. I'm not a kiddie. That was so funny. I didn't watch the whole thing. I just saw some clips. It was pretty good. But yeah, what am I trying to say here is stocks don't just go straight up in a line. And when they do, you get corrections. And right now we've been seeing them go straight up in a line. And now we're seeing a couple warning signs. Does that mean that it's going to fall over? No. It just means that you need to be very careful when you're going long. And it also means don't just go shorting the market one-sided because you get your butt blasted. That sounded weird. You can get pretty tore. Oh my gosh, I'm done for the day. I'm done for the week. I need to drink a beer and hang out. All right. Yeah, I'm done talking. I will see you back on the next market brief later.